Actually, the market breadth is narrow for two reasons. One is that this rally has been led by global money and institutional money, but it's not been led by great participation from local investors. And as you well know, it is local investors, HNIs, who drive the mid-cap and small-cap sentiment. Global investors actually are far higher up the market capitalization curve. There is that reason because of global risk on and expectations of the US-China deal working out, which is where the money has come into very large cap companies, a narrow set of companies, and they have taken the index higher or kept it afloat, while mid caps and small caps have not done commensurately well. The other and more important fundamental reason, non-technical reason, is that, as you mentioned, the economy is still in the doldrums. There is just no pickup in demand. We've seen that even on the industrial side, L&T is talking about the order inflow actually falling short, probably falling short in the current quarter. So both from a consumption side and from an industrial side, conditions are weak. And in such weak underlying economic conditions, where the nominal GDP growth is just about 6%, it's very difficult for mid caps and small caps to do well. Market leaders tend to do well still in such conditions, but lower down the quality curve, companies tend to generally struggle. So while there is a compelling valuation argument for mid caps and small caps now, I think the fundamental earnings momentum argument is still quite weak, and sentiment is also quite weak, which is why mid caps and small caps are underperforming, and the same set of 2025 stocks continue to go up. Of course, it has to be said that a few new large caps, like maybe a few telecom stocks, the leadership in the last few weeks has been in Reliance Industries. So these kind of names have come to the fore in addition to the consumption names which have been leading the market. But otherwise, as you say, it is still a very, very narrow market. There was a phrase in the market which we all spoke about, which was too big to fail. And that used to apply to really the biggest of entities like HDFC Bank and ICICI Bank. But now the financial system is so fragile and overall confidence in the economy is so low that everybody seems to have become too big to fail. The economy just cannot absorb any shock, however small it may be. And that's the reason why even a small bank like Yes Bank has everybody terribly worried that if it fails to raise capital, which is conceivable, what will happen to the fledgling confidence in the financial space? It is still not where it should be. There is still a trust deficit out there between financial companies. Credit growth is still abysmally low. And in the midst of that, if there is a crisis once again on whether Yes Bank is going down, then I think we might just go back to where we were at the, just after the ILFS crisis, and we don't want that. So fingers crossed on Yes Bank. Apparently some investors are ready and they may pass muster with the Reserve Bank of India, but the largest dollop of money, the source of that is questionable, and it is quite likely that the Reserve Bank of India will turn down that request to take in money from such an investor. If that were to happen, then you might easily see the other promissory notes of investment into Yes Bank also disappear, because it would then appear to the people who are promising $100 million, $50 million, they would think that they're putting good money after bad, and they might also withdraw. So I think it depends very much on the Reserve Bank's stance on the larger investor. If that were not to happen, then frankly, Yes Bank, on current situation, without fresh infusion of capital, I don't think it has a basis for existence. And that will probably put a lot of strain on sentiment once again. Last week, there was a strong rumor in the market that maybe State Bank of India will be asked to take over Yes Bank. There is no basis to that rumor, of course, but the market was talking about that because it understands the danger of or the perils of a Yes Bank going down, and it knows that the government will not allow that, and therefore the State Bank of India might be put forward to salvage the situation. So it's a tricky situation. We will know soon enough, but it's a potentially hazardous situation for the financial space. You know, as I said, that too big to fail theory. What basically Kumar Birla was saying is that he understands that the government is in a situation where it will not allow a large telecom company with close to 1.25 lakh rupees of debt to go bad, because the financial system will go into a tailspin because of that. And therefore, sitting at the helm of a nearly $50 billion empire, he's basically throwing up his hands and saying, you know, the government has to waive the AGR dues, otherwise I'm going to stop the company. That, in my book, is nothing short of blackmail. And I think the government should stand up to it. Now, whether the AGR due should be waived or not is a different debate. But the fact that a large businessman can use the government's very tricky situation with the economy to leverage that, to pressurize it, to say that you have to waive those dues, otherwise that debt becomes an NPA. I think it's just hitting the government below the belt, and it's not fair at all in my book. So Sunil Mittal is in the same boat. He's not telling the government, he's contesting that AGR claim, but he's not saying Bharti will shut down tomorrow if the AGR dues are not waived. These are grown up, these are not children. They're grown up businessmen running large businesses. So it amuses me how all these famed Indian corporations who strut about like peacocks when the going is good, but then go crying like children to the government when the going turns sour, as the pit of last resort. In actuality, what should happen is that Idea Vodafone, the stock has already gone that way. Idea Vodafone should go the way of Anil Ambani's telecom company, Reliance Communications. That could not make it a success. That happens in business, and it's gone bust. The stock is a penny stock. Now, Vodafone Idea is still not there and is trying to use that leverage, and I have very little sympathy for that kind of thinking. If an investor is looking for investments in the telecom space, I would say that there are only two companies worth thinking about. One is, of course, Reliance, which holds the telecom business inside it, the parent company, and it has been the leader of the recent rally. And of course, Bharti, which has also had a very good rally over the last few weeks. If the AGR dues were to come through or to be waived, then Bharti will go to 550, 600 very quickly without any doubt, and Reliance will continue its outperformance. So it's a space worth looking at for investors who can take a call on that. But I would caution that looking at the new pricing, it still seems that Jio is going to eat market share from the other telecom players because its pricing remains quite aggressive. No, it's a good thing that has happened, that some of these companies have raised money. And I think a couple of these recent successes like IRCTC, etc., I think have generally taken the taint out of the IPO market. I mean, look at the last 2 years or so, very few IPOs have actually delivered returns. But in the last 3 months or so, we've seen some successful listings and people actually making money. And nothing attracts the retail investor more than the prospect of something working. And IPOs have worked, a few of them at any rate have worked over the last 3 months. And it's a very good thing that the primary market has opened up a bit, because corporations are hungry for capital. And barring a few blue chip companies at the top end of the rung, it's very difficult to access debt capital now for a large number of Indian corporations because of the trust deficit that exists in the financial system today. NBFCs are withdrawing. A lot of the banks will not lend to anybody but the top 50 players. So where do you get capital from? And therefore, to be able to raise some equity capital is very, very heartening for many of these Indian companies. But the problem, Santosh, is not so much that whether 4 or 5 IPOs hit the market and some money is made. The problem still remains, when do investors have the heart, looking at the economic and earnings backdrop, to step away from quality where they are hiding, to say, let me go down and look at some of these other companies because economically the worst may be over. And I think the news economically is just going worse, from bad to worse every quarter, and that is sapping the domestic investor of every kind of strength. So the NIFTY is holding up because of periodic bursts of mutual fund money and FII money, but the larger universe of stocks continues to languish. No, I think there is no valuation comfort in India for the companies who are holding the index up at 12,000 today. But there is no valuation headroom at all. There is no great earnings growth either. The only earnings growth, or practically the only earnings growth we'll get this year, will come from the corporate tax cut. Without that, we would be struggling in the low single digits once again, as has been the norm for the last 5 or 6 years. So in a sense, there is no core earnings momentum in the economy. So what do foreign investors or any investor, why do they buy stocks? A, because they believe that earnings growth will happen, and B, because they believe that the economy will slowly recover and eventually things will be on the mend, and what we are going through is really the worst phase, and valuations are supportive, or they leave some headroom. None of these conditions seem to exist for India at this point in time. So what we are seeing right now is a global risk on, because of the expectation that the US-China deal will happen. That is the reason why emerging markets across the board have received inflows over the last 4 to 6 weeks, and India has also been a beneficiary. I don't think India is being singled out for being the recipient of a lot of FII money, because people believe that the case for India is especially strong. It got some extra money because of the corporate tax cut, which FIIs liked, because earnings estimates went up for a certain universe of stocks. But beyond that, I don't think FIIs are very enamored of the India story, because we have come from 8 to 4.5% in the matter of 6 or 8 quarters in terms of growth, and nominal growth is just about 6%. So if the global risk appetite dies or were to reverse, in your words, for some reason, I think this market can go back to 11,000 NIFTY in a very quick span of time, because there is no underlying economic or earnings support. If the global risk on continues, the market will continue to grind higher, or at least consolidate around this 12,000 mark, led by a narrow set of stocks, with the market unable to spread out further. Well, there will be a bump up. I don't know whether the bump up will happen before the budget in the run up to that expectation, or it will happen on the day of the budget when that announcement comes through. But the burden of expectation has become so enormous that despite a very strained or constrained fiscal situation, I cannot see how the finance minister will not give something. Will it be enough? I doubt it. But it will cause rapture for a while, like the corporate tax cut also did. And there will be a lot of talk about how this is the turning point, and how this massive demand boost will suddenly lead to a greatly galvanized Indian economy. I think the reality is somewhat different. A few thousand crores or 40-50,000 crores of extra consumption money thrown into the hands of consumers is hardly likely to boost consumption too significantly. There are many reasons for that, Santosh. One is, of course, that consumers are not feeling good. That's because of many reasons. Their salaries are not growing, their income is constrained. Other competing pressures like telecom price hikes is taking out some money from their kitty. And generally sentiment is not good, which is typically when even a little bit more money comes into their hands, it does not go readily into disposable income straight away. So for all these reasons, the entire money which is given to households may not go into consumption and have a multiplier effect on the economy. But also keep in mind the extremely tight fiscal situation, which is the reason why the Reserve Bank of India did not, though all the talk has been about inflation, I think it's because of the fiscal situation why it did not cut rates a few days back, because it knows how bad the situation is. There is already talk that there may be GST rate hikes. That's what the states are pushing for, because they're not getting money from the center. And that could take away a lot of the feel good from the consumption or the income tax rate cuts, even if they materialize. So it's a sticky situation. Net, you don't know how much will actually go towards the economic boost we are talking about. And I still think that there is no easy way out of this. We still have a long way to wade through to slowly start the process of recovery, and hope that the long pending changes, which are structural in nature, come through, because if they don't, then we'll only have these small rallies, but not the durable bull market that we are all hoping for.